Good evening, everyone. When written in Chinese, the word crisis comprises of two characters. One represents danger and the other opportunity. COVID-19 has generated significant instability and high volatility in global capital markets. While the full impact is yet to be determined, it's expected that the adverse effects are likely to continue from the virus knock-on effects. What's next? How are we going to reshape our banking and financial sectors? Welcome to the webinar series titled Business Models Amidst COVID-19, headed by the Postgraduation and Research Department of Commerce in association with IQAC, Maharaja's College, Government Autonomous, Ernakulam. By invoking the blessings of the Almighty, let's move on to the session. I invite Dr. Swapna R., Assistant Professor and the Event Coordinator, to welcome the gathering.
Greetings to one and all from the Department of Commerce, Maharaja's College. Today marks the 22nd day of the webinar series organized by Maharaja's College, Department of Commerce in association with IQAC, Business Models Amidst COVID-19. And it gives me immense warmth and pleasure to welcome you all to this international webinar titled Changing Landscape of Banking and Financial Services. So before we get started, I would like to express my sincere appreciation to all those who this possible this webinar series. This is the last one, and I would like to mention or acknowledge the motivation of our principal Matthew George sir, our convener HOD Suresh sir, the IQAC coordinator Santosh sir, our own Sharmila ma'am of Zoology Department, all the technical support by the research scholars, the team, everyone. So I'm delighted here to welcome an international resource for this webinar, the head of liquidity and market risk of Doha Bank. It is a leading private sector banks in Qatar, Mr. Nandakumar Narayanan. He is a chartered accountant also. So the Department of Commerce is proud to have you here today, sir, and I'm sure that this session by Nanda will brush upon a spectrum of exciting and benefiting themes revolving finance and banking. Hearty welcome to you, sir, to this particular webinar. And I, on behalf of IQAC and the Department of Commerce, Maharaja's College, I extend a warm welcome to the HOD, Suresh sir, the panel members of this webinar, the team, Department of Commerce, each and every faculty member of the Maharaja's College, the research scholars, my dear students, and all those who are viewing this particular YouTube streaming, live streaming. Welcome you all to this webinar titled Changing Landscape of Banking and Financial Services by a renowned resource, Mr. Nandakumar Narayanan. Welcome.
Thank you, ma'am. I request Dr. Suresh VN, HOD of our department, to speak a few words.
Respected Nandakumar Narayanan, today's resource person, dear colleagues in the department, coordinator of the webinar, Dr. Swapna, and dear friends. In fact, this is the last webinar program in the webinar series organized by Postgraduate Department of Commerce, Maharaja's College, Ernakulam. I congratulate the coordinator and the members of the coordinating team for their hard work and for their dynamism in fixing various topics, appropriate topics suited to the current context. And I am very happy that Nandakumar Narayanan, CAFRM USA, is a chartered accountant by profession and also a banker. Is a head market and liquidity risk, Doha Bank, Qatar. we know that banking industry is considerably affected by the COVID-19 pandemic, and the uncertainty from COVID-19 will remain for the foreseeable future. Banks and capital markets institutions have no choice but to remain hyper vigilant and rewrite their business continuously. Then only they can sustain business in this troublesome period. Bank needs to actively consider the immediate needs of their people and simultaneously the multiple near, medium, and long-term operations, financial risk and regulatory compliance implications. They have an opportunity to support market and economic activity and to facilitate market firms respond well to these unprecedented challenges. They will not only help society but also increase trust and reputation of the banking industry in the long run. We know that every sphere of economic activity is going through a troublesome period, and I hope that everything will be. See, every institutions and organization will come out from this COVID pandemic successfully, and we are living in a new normal. We are blessed with the presence of Nandakumar Narayanan. He is an expert in the field, in the banking industry for the last 20 years of experience. Liquidity and risk management, that is his area of specialization. On behalf of Department of Commerce, Maharaja's College, Ernakulam, I thank Nandakumar Narayanan for his presence here. Thank you, sir. Thank you for your time and your presence here. Thank you. Thank you very much.
Thank you, sir. I request Dr. Sudesh Kumar, Assistant Professor, to introduce the resource person.
Hello, good evening, everyone. I am delighted to introduce Mr. Nandakumar sir, our resource person for today's international webinar titled Changing Landscape of Banking and Finance. We all know that he is a chartered accountant and he is also a certified financial risk manager. Sri Nandakumar sir is head of Liquidity and Risk Division of Doha Bank. He has over 20 years of industry experience, and his main thrust areas include commerce and investment banking, equity analysis, and share valuation. Welcome you once again. Sir, please go ahead with your presentation. Thank you.
Thank you, Maharaja's College, esteemed professors, Dr. Suresh, Dr. Sudesh, Dr. Swapna, Hani, Ms. Hani, Ms. Preeti, and the entire faculty of the postgraduate research program in Maharaja's College. It is a great honor for me to be participating in this webinar series. I'll try my best to do justice to this program. We have almost a 1 hour session here, so I think I'll speak for 30 to 40 minutes on the subject. Since it is a little loaded with literature, I would request, or I'll just say how I plan to do it. The title is Changing Landscape of Banking and Financial Services. So we'll start by saying how it had a humble beginning, then how the industry consolidated, then how it consolidated, how it grew into a great industry, how the Wall Street was formed, how Dalal Street was formed, and how much people have made a lot of wealth out of this series. Followed with how the consolidated industry is disintegrating into many areas because of digital disruption. Then I'll give a short brief on the different aspects of the financial services industry. Basically, the currency markets and all these markets, equity markets, bond markets, derivative market, stock market, how people can benefit from that. These days things are changing very fast. It is not your knowledge these days is important, it's your behavior. How you assimilate information and how you create it into wisdom and how you implement it in your personal life and also in professional life, which is yielding a lot of success for a lot of people, including me. I once again thank the generous introduction by all the faculty. One by one, now I'll go to the next slide. So this, I just start with the brief timeline, how the banking started. Nothing great here. There was nothing called a bank, it was of recent origin, maybe in Italy. The word came from bank and Germanic origin. Then, what we basically need to understand is that we cannot live without banking. Banking always existed. For example, it was there around 1200 BC also. So it was quoted in Babylon. It was formed in Babylon around 1640. You can find mention in Chanakya's Arthashastra, in the Jain scriptures, etc. So banking was there for a long time. Then it evolved into merchant banking. To facilitate the trades. To facilitate trades, then it got documented. The first documentation in Indian markets, everyone knows it's hundis, which were basically merchant banking from the people known as states. Then it slowly evolved into goldsmith. The goldsmiths are the guys who are kind of strong men who used to keep the bullion and jewelry of the kings and merchants. Then the goldsmith found that they are keeping these funds idle. Then they started lending it, and there come the money lender. So it had a very humble beginning. Then slowly it consolidated into a large industry. Today, if you see the industry value of banking industry and financial services industry combined value is around 125 trillion US dollars. So it's a major industry in the bank. So it had a humble beginning. It's consolidated now. What are the major functions? The banking industry has offered over the past, let's say, 100 or 200 years. So it is majorly the money keeping facility, which we all know, which consists of deposits. When you give the deposit, they give you a certificate called fixed deposit. So it's called certificate of deposits, and the banks normally pay an interest on that. However, these days, the interest as the economy develops, the interest you will see that it will keep on trending down. It is one of the functions of economic development. And due to after Lehman crisis in 2008, you could see that there was a lot of money printing, and the deposit rates are keep on coming down. In the Western countries, particularly, to keep deposits, you have to pay interest to them, meaning it's known as the negative interest in the market. Then the major product in money keeping is savings. All the savings is basically personal savings or retail savings, and from corporates you have large current and call accounts, which basically don't earn any interest. The next big function of a traditional function of a bank is checks and electronic payments like SWIFT, where the payments are made quite efficiently and accurately, transferring of money all over the world. Then the next major function of any bank is the loan approvals. In loan approvals, you will be having wholesale banking and retail banking. So wholesale banking will consist of syndicated loans, club loans, and bilateral loans. You must be familiar in bilateral loans. you have to analyze the industry, top-down approach basically. You have to analyze the industry, then you have to analyze the company. You have to find the strengths of the company, the trends, the repayment metrics, the past repayment metrics, then a credit analysis made. And after that, it is taken to the credit committee where the payments are dispersed through loans. Another that is called bilateral loans. Then we have club loans. Club loans is basically where 4 or 5 banks come together and they share the lending. Syndication is even a larger loan. Slightly complex loans will have syndicated structure, wherein there will be a lead bank which does most of the analysis. Then they take a roadshow and show the loan to different participants, maybe within a country or international also, and this will this loan will be participated by many people. Then comes the retail loans. The retail loans, as we know, is the home loans, personal loans, salary loans, all those categories will come there. Then traditionally, the major function that was done by the banking industry was investments. Investments basically came into commercial banking other than investment banking. When we talk about pure play commercial banks, which we see widely in the industry, what they do is, for risk management purposes, you have to keep some high quality liquid assets in the form of investments with government, in the form of investments with the central bank. You can subscribe to their bonds, government bonds, and things like that. Normally, it is part of the structural liquidity profile, or your these days we call it LCR here or in the Western market. In India, I think it's called SLR. So the investments were kept for that purpose. It should be a percentage of your deposits. Suppose there is a run on the bank, or there is a sudden repairment, there is some pressure or systemic or idiosyncratic pressure on a bank, you'll have to honor your payments. There cannot be a default. To do that, this investments was suggested in the banking sector, and mostly you'll find it is quickly marketable securities, particularly government securities and other high quality liquid assets. After this, the traditional function also had an investment counseling section for the clients. Here, the clients will have many needs, like hedging foreign exchange, integrated banking management, accessing over-the-counter markets, which normally, you don't get access on the internet or, like a stock market. It's not freely accessible. But, there is specialized treasury products, like particularly about swaps, hedges, all these things being provided by a counterparty, particularly by another bank. To access that, we give investment counseling for clients. There will be placements, there will be IPOs, which you cannot directly take to the market. Normally, this is called investment counseling for clients. Then the major traditional sector of a traditional function of a bank was financial services. This is mostly like credit card processing, treasury services like payroll, wealth management, mutual funds, professional advisory, etc. Even some back office functions these days are integrated into a bank. So these kind of financial services are also provided. So till now, what I done is what I wanted to say was we had a humble beginning. It grew into a great industry and consolidated with well-known functions. Everyone knows what a bank does. These are the major functions which a bank does. Then what happened with the introduction of digitization? The industry is getting consolidated. The consolidation is getting fragmented, and it is going to many specialized companies, or the banks has to develop their IT systems to suit the fast-changing dynamics. As you well know that the digitization is impacting banking industry to a great extent. I told it's 125, 150 trillion US dollar industry. Then you will find that there are other industries like transportation industry, another $200 trillion industry, healthcare, another big industry is getting very much disturbed or disrupted by digitization. So what are the factors that are directly impacting the consolidated banking industry? We will see now. So the first one is the digital banking. In digital banking, it comprises, it basically it encompasses digitizing every program and every activity undertaken by a bank and their customers. So what happens is, we get straight through processing. There is no time lags. There is no verification. Everything is integrated, seamless. All systems get integrated. You know very well that the bank consists of front office, middle office, and back office. So for any transaction to pass through a bank, all these officers has to give their okay. Then only you'll get it. Other than some, very, very front-oriented products, other products normally pass through 3 channels. So with the digitization, this is becoming more straight-through processing. So what we have to understand it is, it is not just they are only digitizing for the front-end product that we see on the smartphone or online banking. Every program and every process of a bank is getting digitized. That is where the game is. So once you digitize, it will enable other factions like robotics, artificial intelligence, blockchain. All these rapidly developing and disrupting technologies can be delivered only if you have digital structures within the bank. So the next fallout of digitization, the immediate fallout of digitization was a concept called payment, the transfers. The transfers between banks was done on SWIFT. Then it got upgraded to advanced electronics. Then what happened is that section, because of automation, that entire section passed into another specialized area called payment banks. So here in India, you will find that there are a lot of payment banks like Paytm, Razorpay, Airtel, Amazon, Google Pay. So what has happened here is, these banks can give ATM and debit cards and also online banking, but they cannot take deposits, or they cannot offer loans also. They cannot take loans, they cannot offer deposits. They specialize only in payments. Many payment banks have closed down recently in India. But what I want to emphasize here is, because of digitization, the traditional banking function is changed into a specialized function, and it is run by specialized companies. And those companies are technology giants like Amazon and Google. So, can a traditional bank or a normal bank withstand or compete against a company like Google or Amazon? Remains to be seen. So what happened? What is the other changes in digitization? As I said, since all the processes are getting digitized, you are finding a concept called wallet banking. So what is wallet banking? In wallet banking, you just open your account and you find all your requirements given in one account. You can do your deposits, you can do your loans, you can do your investments, you can buy bonds, you can buy equities, you can buy currencies, everything totally integrated in one place. Here again, we have to appreciate the fact that earlier the bank has to go and deal with another counterparty. It is not just every product is sitting with the bank and they are selling it out of their window. It's not like that. We have to react or interact with other counterparties and deliver the product. Now with wallet banking, all those was becoming seamless. This means what? The bank is interacting closely with other counterparties through secured lines, and instantly you are getting your requirements fulfilled through a smartphone or an online banking. Where is it leading to? It leads to a situation where today, if you see, LIC, I think, has got around 6,000 branches in India. The next big bank should be SBI and HSBC Bank. Should be having 4,500 branches. What if after 5 years you will not find any branches anymore? This will be the situation, or probably there will be one branch per city. So this is what wallet banking is interrupting or disrupting the industry. So now, another interesting area I am opening now is the fintechs. another rapidly growing area. It is utilized to help a company, business, or consumers manage their financial operations, processes, and their lives also by using specialized software and algorithms. The catchword here is algorithms. It encompasses banking, insurance, and trading stocks, everything, everything is run on algorithms these days. Here, the concept is speed, For example, speed and cost. For example, most of you must be knowing that a perfect example might be in fintech, might be the stock trading account. Everyone, we all know that how difficult it was to open a stock trading account. Now it has become just like that, easy. You can open a stock trading account in a matter of 10 minutes. You can find the stock. Earlier we used to pay almost, I think, 0.6%, 1% brokerage charge earlier, before 5 years or so. Now you find there are companies like Zerodha.com where they don't even charge you any brokerage. You can simply trade on that. And if you're taking delivery, there is no brokerage. But if you don't take delivery, there is a brokerage on that on a day trading basis. But what has happened, what has disrupted with fintech is that these algorithms make the business so feasible that they are even delivering service without charging any fees. They play on your float. You have to keep some cash before you trade in the account. On that interest, they are running their business. So you can imagine the size of their business. I heard this company was opened, I think, maybe before 1 year or so, but already almost 15 to 20% of the entire brokerage in India has been captured by a company called Zerodha. That is the level of disruption that is happening to banking and financial industries. Again, it is also disrupting insurance sector. It works on blockchain and cryptocurrencies. Everything, you say anything about financial technology implemented, it's called fintech. Whatever you find is fintech these days, and there are a lot of companies in fintech. The industry size of fintech, the funding received so far in fintech is about 35 billion. So you can imagine the speed of change happening here. Then the most important dynamic that is changing is the artificial intelligence and RPAs. So how is artificial intelligence used in banking? So this best I can explain through some examples. Earlier when we used to go to bank, in the lobby you will find a relationship manager sitting there. You have to go and wait in the queue maybe for 2 hours without AC, and finally reach the relationship manager, and he'll ask you 100 questions, and your work will not get done. You have to go back to your home and bring back new documents. All those things are done. Now it's called virtual assistants, enabled through artificial intelligence. The AI reasoning, and it understands natural language also. And using that, it handles all kinds of sophisticated questions about financial management that was earlier done through humans. Then what is other artificial intelligence robotics? You can find mostly, I don't know whether in India it's available, but if you come here in some banks, we have it in QNB, Qatar National Bank, and you have a lot of banks in USA and London where you will find a robot rolling on the lobby. So you can just call it and press on its chest. It will ask, it will give you a token. It will ask whatever services you want. You can tell it. It goes back. It collects your document, goes back, comes back, and your work is done in half an hour time, and your account is opened, or whatever is your query, it is done. This is another implementation of robotics. Then today's smart banking, everything you can do on a tap of a button. You can buy, you can sell, you can do your banking, transfer, everything. That is primarily sitting on a concept called biometrics. So you want biometrics. First, this is the gold standard for instant banking. So that is also controlled by artificial intelligence. It is widely used on trading floors. I heard in Goldman Sachs, there were about 600 traders on a trading floor. Now it is reduced to just 2 traders because of artificial intelligence. That is the power of technology. It is used in financial risk management to a great extent because the algorithms will track any pattern which is not a normal pattern and alert, immediately that is checked. And anti-money laundering, risk management, financial management, everywhere AI is getting used, artificial intelligence. So that is also disrupting the industry to a great extent. Then the change is happening through a concept called blockchain. This is a very large and very rapidly growing area. Bitcoin, all these new technologies, you are finding in the industry is based on blockchain. So what is it hitting? How it is hurting the bank? It is hurting the bank in its strongest area, but underknown area, which is called trade finance. Most of the retail investors might not have experienced trade finance, but trade finance is a major section of a bank. Basically, it is used by business people for opening LCs, discounting LCs, opening letter of guarantees, everything. So as I said here, how the banks got this business, which was a very profitable business, how it got was, it is facilitating trade. To make an import, you have to get an order from let's say to make an export, you have to get an order from an importer. That order is taken to the bank. He says that I want a letter of credit against this. The bank gives a letter of credit. He takes the letter of credit, goes to a merchant, shows him the letter of credit, and takes goods on credit, comes back to his office or its workshop or whatever, and he adds value to the product and then exports it to the exporter. So what happens, when the letter of credit is given to the supplier of goods, what he does, he doesn't keep it with him. He immediately goes to his bank and discounts that letter of credit and takes money against it. And so on and so forth. Then again, the chain continues. So you could understand how wide the industry was. Now that is getting totally disrupted by a concept called blockchain. So what is blockchain? It is a system of recording information in a way that is difficult to change, hack, or cheat the system. Essentially, it is a digital ledger of transactions that is digitalized and distributed across the entire network of computers or computer systems. That is a block of computers. So that is called blockchain, and it is disrupting the industry to a great extent. All these today's exciting concepts of Bitcoin is based on blockchain. The next large item is the big data and financial services. So how this has changed? Earlier, the biggest issue for any bank was it didn't have any kind of validated data. So most of the data is what the customer says to you, what the customer's financial report says to you, and what is your experience about that customer. Those things started changing in the past 20-25 years. What happened is we had a centralized system slowly coming into the industry where if he defaults in one bank, he'll get registered in that banking system. It was only accessible by the banks. So suppose we have a customer, we can always go to the system and inquire about that customer. It will tell his credit history. If he has defaulted that loan, this bank, that bank, everything will be seen. So that it started there. Then, all technology companies, with the introduction of a lot of new products, as I mentioned earlier, what happened is we started exchanging the information, and there was a common information center, and the information is sold. There are different services offered by the leading tech companies where banks can buy information by paying. So, if you see a practical example, if you see our Bajaj Finance, you can walk into any showroom in your city or village and say that I want a fridge, and the guy and you can say that I don't have money, I want it on credit. So he goes back into his office and checks and comes back and says, "Sir, your credit is approved." How is it? How he does that? He does that with this concept called big data. So all your data profile, even which film you went, which ice cream you ate, everything gets stored. It says how many times you are defaulted, what is your salary, how much time you have changed your jobs, whether you are continuous working, whether your salary is increasing or decreasing, everything is known. And it summarizes into small concepts like your credit score, or if you want some other information, it comes there. So it immediately says this guy's credit score is more than 80%, loan approved. Less than 50%, loan rejected. That's it. So this is how it is being used. It is being widely used, as far as I know, by another bank in India called HSBC. There might be more banks, but these are the banks I know. But in the Gulf, in our region, this is not that much used because because of the small size of the population. One, secondly, here the privacy of the local people is also much respected. So we don't get that kind of services that you are having in India or in Western market. Okay, so you could appreciate the fact that many traditional functions of the bank are basically handled by some kind of technology companies, or the bank has to become a technology company. So should we call it a bank or a technology company in future will become a question. But then someone can say that, okay, everything has gone, but you cannot do away with lending. That requires specialized lending. So I like to bring the concept of P2P lending. So if you see this P2P lending, it's called peer-to-peer lending. It's available in India, as I understand, in some companies, but it's very much available in the Western markets, particularly London and US. In the Gulf market, it is not available. But what happens here in peer-to-peer lending is, again, you go to a company and you say that I'm an investor, and my friend comes to the same company and says that I'm a loan taker. So as an investor, if I open my account, it will show that about 20 people are waiting for loan with this kind of interest. Maybe let's say it starts from 4% all the way to 25% interest, and it will give the base profile of the person. It will say that this person wants the loan for this purpose. He'll be investing in this area. This is the expected returns, his profile, how many times he's defaulted. Everything is available to you. So for a person like me who is experienced in banking, I can say that I will take a 20% interest yield because I see the risks are low, and based on his default history, I am ready to give loan to him directly from me to that person. I don't know the person, but the company will ensure that the person's funds are received and paid back to me. This is called peer-to-peer lending, which is happening in many parts of the world. Having said all these things, I would like to invite your attention to this concept called under-penetration of banking. Despite all these things that's happening in banking, despite its glorious history, despite it being dominated on the Wall Street, despite its 125 trillion market capitalization, all those things, in India, banking is still very much under-penetrated. If you see the global population, many people don't have banking. So there is still room to grow. But who will grow is the question. Will it be tech companies? Will it be non-banking financial companies? Will it be shadow banking or the banking? Everyone is dependent on one common factor called technology. That is the point I would like to pass on. So I want to just open your mind to see, to be a future banker, should you know banking or should you know technology? Will the banking called a technology company? Can bankers work from anywhere? So all these are the fast changing dynamics. Now I'll go to the next section. It's called rethinking the concept of money. So money, as we know, we all know that money was the currency notes, the coins, even the gold, silver, bullion, copper, whatever you call, all kind of valuable commodities can be called as currency. Even in bank ledgers, gold will be opened as a gold currency. All those got changed, or the concept of money is getting changed due to some factors which I will highlight on this slide. So first factor is called Bitcoin. It's nothing but cryptocurrencies. It operates on the blockchain framework and data mining. But why is it getting value? Now you would have heard the stupendous value of Bitcoin. Why is it getting value? It's getting value because it is available in low quantity. You cannot mine it just like that. You have to go through the algorithm, and you can mine it. Only very few bitcoins are available. Since there is scarcity, the value is shooting through the sky. But this currency has got some weakness. So I will not even call it currency. This commodity has got some weakness because it doesn't have a regulator or a central bank. The transactions are validated through cryptocurrency, cryptocurrency model and distributed over blockchain. But the issue is anyone can use it. It is not restricted to certain people. It is not regulated. Anyone can use it. Illegal people can use it. It can be used for drugs. It can be used for anything. Therefore, is there a future for Bitcoin? We have to see. But does it have value today? You would have become a billionaire now if you have owned Bitcoin at the right time. And there are a lot of other cryptocurrencies around. Okay. Now, again, the second concept, which I thought I will explain in this rethinking the concept of money, is overprinting of money and its value. So, actually, there is too much money and too many money avatars. You'd appreciate by this time. But does money really have value? It's just paper, no? Does it have value? Why do you say that $1 is worth 75 rupees? On what basis? It's just demand and supply dynamics that is getting the value. But is it really valued so much? What is the intrinsic value of a dollar? It has lost its meaning because there is unending supply of money printing by the US Fed, even in India, even in all Western countries. You have a problem, it's a no problem. We'll just print money and give it to you. I have a printing press. So there is no problem. It started with widely with the Lehman crisis in 2008, the financial crisis. If you remember, some banks had a run on the bank, and the bank was about to be closed, and it was having a chain reaction like a nuclear bomb. And the entire financial industry was looking into a deep well. At the time, Alan Greenspan, the US Fed chairman, came and said that, don't worry, we will buy all your bad loans. Give all your bad assets to me. I will give you money. From where? It is not supported with gold. He said, I'll just print it and give it. So that started the printing of money in tons. There is no, there is no limit for printing of money. You have an economic disaster, no issue. We'll print money. I'll take all your bank assets. No bank will go bankrupt. I'll take all the bad assets. Now, even in India, they're calling a concept called bad bank. So whose money it is at the end of the day? Is it retail investor depositors' money or some other people's money? Will you get your money back? Even if you get your money back, will your money be valuable as olden days? All these questions are coming up. And can US dollar be printed to eternity? Will the dollar crash? If it crashes, which assets will lose value? What will happen? All these are big question marks, and it has to happen one day or the other. And that will be called mother of all crashes. The day US dollar crashes, it will be doomsday. So I don't think it will crash in one go, but it will slowly lose its value. It's already losing its value, and emerging markets will gain value. Again, when you say the concept, rethinking the concept of money, this PPP, purchasing power parity. So most of you would know in economics that India is about 3.5 trillion US dollar economy. USA is about 23 trillion US dollar economy. China around 16 or 18, I don't remember correctly. But why? What is the difference? We are eating low here. We don't go to cinemas. We don't wear dress. What is the reason for this? What are they doing more in USA other than making smartphones and technology? Why their country is more valued? That is because of the dollar's value. The moment the dollar is the reserve currency of the world, the day dollar loses its value, you will find the concept of PPP coming in, purchasing power parity. If you do a purchasing power parity valuation of Indian GDP, I think it is about 17 trillion US dollars. Sorry, around 14 trillion US dollars. So that means, if you take China, it should be around 30. If you take US, it should be around 28. So first is China, second US, and third is India. So once you remove the valuation differences, then you'll find that the goods and services enjoyed in all these countries are more or less equal. This is the next concept is the dark side of money. It's called money laundering. Where people use the financial systems to layer the money, to make placements, integration, and somehow get through the banking channels. There are a lot of regulations being introduced these days, a lot of controls, compliance functions introduced to central bank. There's a Basel committee who has given a lot of restrictions, how to do tracking. There is specialized laws in US markets, in European markets. But despite all these things, money gets laundered. That is a hard truth. I will not touch on this too much because it's a subject in itself. Then we come to the fourth pillar, which is the facilitators in the financial industry. So what happens is, if you go into what most of the retail people know is, consumers know, is that, you have a bank, there's a commercial banking and all those things. You go to a branch, you meet a banker, you tell everything. But there are large markets working in the shadow of this one, of the banking industry. It's called financial services. So there are different markets in this one. The biggest, these are basically used to store money and exchange money, or store your assets and all those things. So the biggest market here is the currency market. This is basically the forex market, where the currency is exchanged. The G7 currencies, Indian rupee to dollar, dollar to euro, euro to pound, all those things. So this is the largest market in the financial services industry. The daily value traded in currency market is about $7 trillion US. The major products that are used is forwards, swaps, options, derivatives, and things like that. And also spot markets where you just like that exchange money. The next market, which is working in the background of financial industry, is the bond market. This again is a huge market. The size of this market is about, global size is about $100 trillion US, $100 trillion US. This is used basically for issuing debts. Most of the debts are issued by sovereigns, meaning the countries, and by banks. So here the major products are bonds itself, or sukuks in this market, in Gulf market. In Indian market and Western markets called bonds. You have the treasuries, US treasuries, government bonds, and all those things. Then there is a large derivative market called interest rate swaps. So you can go to Google and search for swap curve. You'll find the swap rates instantly quoted. So it derives its value from the US Fed curve, interest curve. And another thing is, if you have a bond, you can always, there is another big market working in the background. It's called repo market. A repo is nothing but it's repurchase agreements. So you can simply go to a bank and go to another counterparty. For example, one bank can say that I have a lot of government bonds, or corporate bonds, or bank bonds, or whatever bonds, municipal bonds, whatever. You go and sell it to, discount it with another counterparty, basically another financial institution or bank. They keep it as pledge and give you money. That is called repo market. So these are the three constituents of repo market. It has got a lot of manifestations in terms of valuation, swap valuation, bond valuation, hedging percentages, hedging ratio is quite interesting. We ourselves are running a huge book. Then the next big market is the equity market. Very interesting market. Here, actually, boys or girls can become men and women here, because it will really test your skills to invest in the stock market. But again, here I'd like to emphasize, it is not your knowledge, but it is your behavior in the market. It's your behavior and attitude for picking the companies and staying in the market. So it is very important that young people get into this market and stay in the market for a long time. It is time in the market that makes money, nothing else. You cannot be a magician. You cannot be a fortune teller. You cannot make any bets. It is basically your time in the market with good stocks and your understanding of the market that will create wealth for you. What will happen in India? India is in a structural bull run. I have been saying this for the past 10 years. I will say that for the next 2 decades also, India is in a structural bull run. A lot of wealth can be made in this market. It is very much available for retail investors. Only thing it requires is dedication and understanding and daily reading of financial statements. There are a lot of secrets in business, as you know. If someone is doing business, you will know that you have your own USP. There are a lot of secrets, but once you learn to read the financial statements, you will understand all the secrets, whatever be it, it reflects in your financial statements if you are not putting the financial statements. If you are a good company, having a clean balance sheet, clean accounting, whatever secret you do, whatever is your USP, will be reflected in the financial statement. And the moment any retail investor or a corporate and whatever, whichever investor be it, they understand those secrets, tons of money is to be made here. This is my message. Then the next major industry is the derivatives. Derivatives also consists of lot of interesting instruments like swaps, options, um, forwards, everything. Basically, derivative derives its value from another product. So, you might be having a stock or a bond, it derives value from that. Meaning it will change as per the value changes that is happening in the underlying instrument. For example, if you have a bond will have its value, but its derivative will be interest rate swaps. So interest rate swaps will have another value associated with that bond. So that is derivatives. Here again, it's little complex. Different derivatives has got different characteristics and different valuations. Here the game is all about valuations. And there are a lot of markets for this. Our stock markets are there. Indian stock market itself is more than the economy. It is about 125% of our GDP. Today, BSE and NSE combined together should be around $4 trillion US. You go to US, you will find a 25 trillion market. You will find all kinds of stock making plenty of money. You will find Tesla stock has given 100% returns in the past 3 months. There are a lot of stocks like that in India also. So you can appreciate that, the concept of valuation. The next concept in the facilitators of financial industry is investment banking. In investment banking, what happens is we handle complex transactions. Here again, the key is valuation, negotiation, and expertise. You should have expert understanding of the product or industry, and experience is very vital here. One of the subsector of investment banking is venture capital. Today there is a big startup market in India. A lot of startups are happening. The investors are mostly investment bankers. Again, the main concept here is the valuation, your domain experience. You should know what is doing basically, and you should know intricately. That is what venture capital is all about. It is not seen in the capital markets. You will not see it in a listed market or even in a bank. It is a specialized section, but there are large profits. Again, private equity is a cousin of equity markets. Only thing, it is not listed. Here, the major players will be large funds, hedge funds, direct investments, buyouts, delisting, you name it. Everything comes under private equity. Again, it's specialized. The concept here is our specialization and your valuation expertise. Okay, so retail investors, how do they store their wealth? It is in India, if you see, most of the wealth is stored in real estate, gold, silver, bullion, real estate again, big time, fixed deposits. Other than this 95% of Indian savings is in this area. So as I said, as I was just explaining, there is a lot of disruptions happening in the value when in the banking industry. And when the disruptions are happening, what you'll see is your gold, silver, bullion, or even your fixed deposits or real estate will hardly earn 4%, 3% returns, which is lesser than the inflation. You don't get more than, I think, 2% yield on your properties in Mumbai because it's so expensive. If you compute the rental yield, it will be 2% or so. If you come to Bangalore, maybe it's around 4%. If you go to Kochi, I don't know, maybe it should be around 4%, 5%. So what will you do with 4%, 5%? And at the same time, your rupee or your currency is losing value, but Indian rupee will gain value. But suppose you are in US market and your rupee is losing value, what will you, sorry, your dollar is losing value, what will you do? You are not getting any yield. Your deposits are getting negative yield. You have to pay to the bank to keep your deposits. What will you do in this situation? So what I suggest is, we have to understand this dynamics and move into financialization of savings. Move from the traditional investments and where you have been storing your wealth and get into other markets like stocks, equities, bonds, etc. So with this, I hope I have completed my presentation. We started with the humble beginnings of banking, how it consolidated into a large industry, and how that industry is getting disrupted. And when the disruptions are happening, the investors or the retail people should understand this moves. Even a non-banker has to understand and invest in the correct areas so that their hard-earned money will get good returns or sufficient returns on capital. So I'll close my presentation with this. Thank you so much. Back to Dr. Swapna.
Sir, it was a wonderful presentation, sir. And we have some questions. And before that, I would like to ask some questions to you, sir. I've heard that your bank is lending to big corporates also, sir. Who are those big corporates? Can you share it with us? And how about these NPAs, non-performing assets? How do you manage these NPAs in your bank?
Sure, sure. Basically, the structure of our industry, Gulf industry, if you see, it's slightly different from Indian industry. Here, the major depositors are public sector companies. Basically, the large Qatar Petroleum and this kind of companies have majority of the deposits. So what we do is we take the deposits and we lend to different loan takers, borrowers. So what happens is, our ticket size generally where I was handling was large ticket size. When I was in credit, around a billion Qatari riyal, you may say, or at least 100 million Qatari riyal. That will be the ticket size. So we have lent, but when we lent it, it was a very good market. After that, the market started slowing down, and we are impacted by this corona. So what has happened is, many of the companies where we have lent is not able to, not only us, it's for the entire financial sector industry. Wherever they have lent, they are finding it difficult to get it back. So that creates a lot of NPAs, non-performing assets, and it creates a lot of stress on the balance sheet. So what happens, then we have to take higher NPAs. If you see in India, I think the average NPA across the banking industry should be around 15%. We had noted it quite early, and we have taken steps to control it by reducing our lending, increasing our recoveries, and going for out-of-court settlements. Even in India, it's a major problem. Some of the banks in India has done a wonderful job of having low NPLs. Like if you take HSBC Bank, I think you'll find the NPL around 1.5%, if I'm not mistaken. Whereas if you take SBI, it should be around 5%. If you take some other banks, it will be around 15%, 20%. Basically, they have lost their capital. The banking is structured in such a way that you have capital of about 10% of your liability side. The remaining will be borrowings and things like that. And you leverage 7 or 8 times on your capital. So your book size, asset size should be around 80 million or 80 crores or whatever, basically it's your capital. The remaining money is depositors' money, right? It is retail depositors' money. So when the NPA problems happen, what we are talking here is basically whether the depositors will get their money back. So it's a major issue. It has to be addressed quite in a very structured manner, so that the bank also survives, the client also survives, the depositor also survives. You would find in the recent budget, Nirmala Sitharaman, our finance minister, has said that they will be capitalizing the public sector banks where most of the NPS has happened. Here also there are a lot of support being offered by the government. In US market also, that they are using a lot of stimulus in US market, which is basically printing of money. But will it have a nice ending? I don't think so, because money should not be printed in such huge number. The bubble has to burst on Monday.
We have someone else. There is a type of banking called Islamic banking. Where is it? Which does not give any interest to the depositors. And will this system help banks in lending loans at lower rate of interest? That's a question.
Actually, this Islamic banking is based on the principles of Quran, wherein it is not correct to take interest. The concept of interest is not there in Islamic banking. Therefore, they don't take any interest on that. But what happens is, in Islamic banking, in my opinion, this is my personal opinion, the base structure for Islamic banking is some Islamic structures are there where you can mostly lend only to real estate, or you need an asset-backed structure. You cannot just like that give a personal loan, or you cannot give a loan without a collateral. Mostly if you want to take a real estate loan, you have to pledge your house as collateral, right? In business also, they'll be having some other pledges or some collateral will be given. But in Islamic banking, that is the bedrock. You cannot do anything without a collateral. So when they take a collateral, they give loans against that, and that is re-engaged into the business. The profits are shared. Actually, the concept is profit sharing. The second leg of the question is, will this system help banks in lending loans at lower rate of interest? Well, I don't think so, actually, but they have a lot of protection on the interest rate, because if you see non-Islamic banking industry or structure, the biggest risk for a bank will be liquidity risk. Next is credit risk. Third is the interest rate risk. This interest rate risk is a silent risk. You will not be seen on a day-to-day basis, but all your assets and liabilities will get repriced with the changing dynamics in the interest rate curve. Okay, so that is where the commercial banking industry is exposed to interest rate risk, whereas Islamic banking is not exposed to that interest rate risk. So what I mean is, you can always charge your customers more interest rate if you want. You can increase your profit rate. It's called profit rate there, for a share of profits. Whereas in commercial banking, it will be difficult, or non-Islamic banking, it will be more difficult to do, because invariably all your assets and liabilities will be linked to the country's curve, or LIBOR, or US swap curves, or some curve. It should be linked to some curve. So that is the difference between Islamic banking and conventional banking.
How banks are managing this in export-import bills, and is that same like Indian when compared with Doha Bank?
Yeah, it's same like India only. There is no difference in that. FX risks, we have to take FX swaps. Basically, no bank will keep the foreign exchange risk open. What we do is we always hedge it with the counterparty. Invariably, you will be, what is the derivative is, where it goes actually is the liquidity risk and the interest rate risk. As I said, even if you take, let's say in India, if you take a dollar loan from another financial industry, so there is a foreign exchange risk here, right? Indian rupee and US dollar. So as a bank, let's say you're taking that from HSBC, that bank will go and take the loan or say same foreign exchange from another bank, let's say, or from abroad. So that risk is actually negated for the bank. They don't keep it, but still some risks will manifest in terms of interest rate risk. Because once you give a loan, then you have to repay the loan also. So at that time, the repayment interest rate might be different from what the interest rate you have given the loan. So it will manifest as interest rate risk, even though foreign exchange risk can be hedged or controlled in a major way.
What is the future of Bitcoin? Hi,
Yeah, there's one more question. I'll take this.
Yeah, you can answer that question, Devika. She's a student. Is payment gateways like Google Pay, PayPal, like apps require permission for operating it in a country? And
Yes.
who will be responsible in case of money?
Oh, see, all these banks, all these banks are, all these companies will get regulated in one way or the other. But Google Pay, PayPal, and all, I don't think it is regulated by any banking industry. But if you are talking about payment banks, there are a lot of payment banks being approved by Reserve Bank of India. Those companies or those banks are very, very much regulated by the banking regulator, which is RBI or similar regulators in other countries. But I'm not sure about Google Pay. Probably they'd have got some kind of approval from them. I have to check it out. Google Pay and PayPal, I'm not very sure. But yeah, your question is valid. There might be some risks in that. But given the reputation of these companies, I don't think there will be any money loss or things happening like that. But it is not totally avoidable also, unless it is fully regulated. In India, the payment banks are regulated.
So, can you answer? So what is the future of Bitcoins?
Actually, see, Bitcoin, what is Bitcoin? It is just a currency or a commodity, you can say like that. It's a currency. Let us say it's a currency. So the currency was never invented by a bank. It was invented by general public, and then the currency was adopted as a means of transferring money and all those things by the banks, and the banks got a regulator. So the currency got regulated. That's all. Nothing more than that. Same thing will happen to Bitcoin also. The technology is there. The technology will be taken over by the banks or by the central bank or by the government. In India, already our Prime Minister Modi has said that we will not allow Bitcoin and all this in India. It will be the bank, the government itself will issue its own digital currency. So digitizing currency is not a big issue. Already we are digitized, right? We are making a lot of purchase on the internet. We are using our ATM card in shopping malls. It's all digital only. Now, bringing out a digital currency is not a big deal, and people will get trust, and it will also get regulatory monitoring only if it is regulated. So, I think Bitcoin will not have a big future. Even Warren Buffett and this kind of big people, big investors, have also said that it will not have a big future. Logically, it doesn't appear to have a big future. It is based on blockchain. Blockchain is a technology anyone can use, but today it has got a lot of value. Today it has created a lot of millionaires. I heard one guy lost his password, but his account value is around 200 million US dollars. So he's not able to use it. Raja, good evening, sir. Our export import this negotiation facilities.
Yeah, that's right.
Yes, it is there. Very much there. You can see a lot of banks branches are available in the Gulf. There is no problem with that. You have Yes Bank, you have State Bank, you have Bank of Baroda, you have HSBC, you have ICAC, you name it, everything is available. So negotiation is not a problem at all.
There is a question from Suraj. As a specialist in banking and market risk, what is your advice?
Thank you for this question. It's a very relevant question. As I said, about 90% of Indian savings are kept in real estate and fixed deposits, gold, silver, bullion. Now, as you see, recent days you are seeing gold values coming down. very volatile currency. People don't know what is the dynamics behind this currency. It is a commodity actually. Real estate again is a commodity. What is the yield you are getting? Sometimes the price goes to sky levels. Now the real estate has corrected for some years, but before that the real estate was very high. But the rental yields will not be there. So, and definitely you are seeing, if you see the number of accounts opened in a stock trader or with a broker, it's amazing. The number of accounts opened is it's growing by the millions every day. This indicates that the retail investor or retail people have already realized the risk in keeping their money only in gold and real estate and all those things. I heard one of my friends has got 35 pieces of real estate and 20 properties. 35 properties he has got in Bangalore, 20 is unoccupied due to Corona. This is the situation. So what he'll get on his money back? Many people are investing in real estate to avoid income tax, is what I heard. These kind of things are happening, but I don't think long-term basis you'll not create any wealth out of it. If you want to create wealth, you have to move into the companies which are generating wealth, to understand that there is a lot of information widely available on the internet. Because you might work as a CEO, you might work in a big company, that's so fine. But at the end of the day, you have to know to manage your money also. Otherwise, what is the point in your savings? If your savings is depleting every day, it's not a good idea. So people will be forced to get into other forms of money, which grows equal to your economy or faster than the economy. That is for sure, no doubt about it.
So there are no more questions. I suppose we rang with a vote of thanks by Dr. Preeti Menon, Assistant Professor at the Department of Commerce, Maharaja. Please, Preeti.
Thank you, teacher, and good evening all. And I feel privileged to propose vote of thanks at the end of this webinar series organized by PG and Research Department of Commerce, Maharaja's College, Ernakulam, titled Business Models Among COVID-19. I take this opportunity to express our deep appreciation and gratitude to the resource person, Shri Nandakumar Narayanan, Head, Market and Liquidity Risk, Doha Bank, Qatar, for sharing his expertise on banking and financial services. Please accept our gratitude, sir. Thank you very much, sir. My sincere thanks. Okay, sir?
Yeah. I want to thank back. Particularly Maharaja's College. It's very prestigious. It's a research wing and commerce division. Dr. Swapna, the HOD Dr. Suresh, Dr. Sudish, Dr. Preeti, research scholar Hani Cletus. She has helped me a lot in presentation. My friends, some of my friends have already joined this program. Some of my family members also, I thank and appreciate their time. It was really a very good experience. And I also say, I would like to interact with all of you, with your students, anytime. I will share my email and WhatsApp. So, we can keep discussing. You might have a lot of doubts, how it gets implemented in the industry. Particularly what you read in books might look very daunting. If you want my help, please approach me. I'm always available. We can discuss on subject, because I always like discussing, because it only enhances my knowledge. There is nothing to lose. So this is my principle. So if anyone wants to get in touch with me, more than welcome. And once again, I thank you, all the faculty members, excellent team members, superb personalities. Thank you so much.
Thank you very much, sir. And we are also happy that you are with us. And we are looking forward for it, sir. Thank you very much. And my sincere thanks to our most respected HOD, Dr. Suresh VN, our beloved webinar coordinator, Dr. Swapna R, IQAC and DQAC coordinators, webinar team members, and all the faculty of the Department of Commerce. Special thanks to our research scholars and all participants who have made our webinar series a success. Once again, thanks to one and all. Thank you and good night. Thank you.
Thank you so much. Good night. Good night to all of you. Good night to all of you.
Yeah. That's
much.
sir. Thanks a lot from the Maharaja's College hired me for devoting your time with us, and we look forward to your association with our department, with our students. Thank you once again, sir.
Thank you so much. Good night. Good night to you. Good night. Good night all.
Good night, sir. Thank you, sir.
Thank you.
Thank you.